Okay, so this will be our lecture on Chapter 5. Chapter 5 is accounting for merchandising operations. And we'll start with the identification of two types of merchandisers. The first being a wholesaler. And the wholesaler um, effectively sells to other businesses. All right. The next being the retailer. All right. And the retailer is different than the wholesaler in that they sell to the end consumer. All right. So we obviously have experiences with retailers. If you've ever been to Walmart, Target, retailers are now also online, such as Amazon, or etc. What we have here is it's effectively a map of the income statement of a merchandiser. So we have some experience creating the income statement of service companies. That's what we did in Chapter 1. It's kind of what we've done up to this point. Well, the income statement for a merchandising organization it conveys the same information, but we typically have an intermediate step. So you still start with revenue. All right, so you start with revenue. However, we see some accounts that we would not have seen on the income statement for a service company, namely cost of goods sold and gross profit. All right. Cost of goods sold is effectively the cost of all goods sold. It's deceptively named, I swear. The cost of all goods sold during the period. All right. So merchandisers buy inventory and typically sell it for more. That's their business model. All right. So if you can imagine, sales revenue less what the company paid for those goods sold during the period gives us what we will refer to as gross profit. All right. Gross profit. And we can think of gross profit as the amount which is left after paying for all goods sold during the period to provide for operating expenses and also the difference between gross profit and operating expenses is what we'll refer to as our net income. Or if operating expenses exceed gross profit, we will have a net loss. What we have here is the operating cycle of a merchandiser compared with the operating cycle of a service company. And we see the merchandiser has more steps. Right? Because the service company, we see they perform services and then collect on those services, and the process is repeated. With the merchandiser, their operating cycle includes buying inventory, marketing that inventory, and once that inventory is sold, collecting via accounts receivable, or if it's a cash sale, that you can skip that receivable step, and then buying more inventory or repeating the process. All right, so this is just a comparison and contrast in the operating cycle of the merchandiser and service company. Okay, this is going to be a concept that sticks with us for a couple of chapters: the flow of cost. And inventory. Inventory is an asset that shows up on the balance sheet. And the ending inventory at the end of the inventory on hand at the end of one accounting period is the beginning inventory at the beginning of the next or the following accounting period. Right? So when we have our beginning inventory, that is just the amount left over, unsold inventory from the prior period. Alright? Cost of goods purchased during the period it reflects the cost of goods purchased during that accounting period. Alright? Those two numbers together make up what we will refer to as cost of goods available for sale. Alright. Now, cost of goods available for sale is an important number, and we'll spend part of this chapter and most of next chapter splitting that up between cost of goods sold and ending inventory. And cost of goods sold is, of course, the income statement expense account. Right? So when we hear cost of goods sold, we want to think expense. That's the direct reduction of sales revenue to get to gross profit. Ending inventory, well, that's what's left over. That's unsold inventory, and it rolls to the next accounting period to become beginning inventory for the next accounting cycle. All right. Okay, there are two main methods of accounting for inventory, and they are the periodic system and the perpetual system. I'm going to talk about the periodic system first, and then we'll talk about the perpetual inventory system. All right? The periodic inventory does not keep detailed records of the amount of inventory on hand. Alright, so in an accounting problem where you're given a periodic system, you assume a periodic system is in play. What you will need to do, or what you'll be given, I should say, you'll be given beginning inventory, you'll be given purchases during the period. Those two things combine to give you cost of goods available for sale. Alright. The periodic inventory system also requires a physical count at the end of the period, and that physical count gives you ending inventory. And you can subtract ending inventory from the cost of goods available for sale, the inference being that the goods that aren't still available in ending inventory were sold. So that's how we get cost of goods sold in a periodic inventory system. Right? I will state that the periodic inventory systems are they require less resources than the perpetual inventory system that we're getting ready to talk about. They require less inventory resources, but they require less technology resources, but they're really not as widely utilized, and mainly utilized by smaller companies with less sophisticated accounting processes. All right. Because they don't provide for the real-time monitoring of inventory. You have to wait till the period ends to determine what's on hand and to determine cost of goods sold. Alright. The perpetual inventory system, I would say that this is the standard for medium to larger retailers. most of your retailing experiences, where you walk in to a retailer, select your items, and at the point of sale, you select items and the cashier scans them. That scanner is part of a perpetual inventory system. All right? Those systems are able to keep detailed records of the cost of each individual transaction, which means that they are, at least in theory, able to analyze the cost of all goods purchased in a single transaction, a single hour, a single day, a single week. It provides for much more powerful inventory analysis. The other thing that perpetual inventory systems do is when I purchase, so if there are 10 jars of peanut butter on the shelf at Walmart and I buy 2, when I have paid for those items and walked out of the store, the perpetual inventory system updates that and now shows that there are 8 jars of peanut butter still available in inventory. So as you can imagine, that's important for online retailers. That prevents them from selling goods that they don't physically have in inventory. Most online retailers are using a perpetual inventory system. And quite honestly, most retailers of any substantial size are using a perpetual inventory system. Okay. Some of the advantages of perpetual inventory systems. The biggest and best advantage is the better control of inventory. So the cost of stockouts, that is running out of inventory that a customer is ready and willing to buy, are minimized because you can order when inventory gets low. You can set up the perpetual system to set an alert that when it's time to order more inventory. And some of the more sophisticated merchandisers actually have a setup where their system is automatically orders from the supplier. Walmart uses a similar system that when they get too low on Colgate toothpaste, their system sends an email to Colgate system and more product is dispatched automatically without human intervention. Okay. So now we're getting ready to talk about FOB shipping point and FOB destination. This is an important concept to understand, mainly because it determines who owns the inventory. All right. Most transactions, virtually all consumer transactions, and most business-to-business transactions are done FOB shipping point. Alright. FOB shipping point, it's an acronym actually. It means free on board shipping point. And it really is a concept that all the seller has to do is tender goods to the public carrier, be it FedEx, UPS, United Parcel Service, or United States Postal Service, or whoever the carrier may be. Once the seller has given or tendered the goods to the carrier, ownership has passed, and they are legally the inventory or property of the buyer. All right, so that's most consumer transactions. Most of the time, when you order from Amazon or Walmart.com or whatever e-retailer you want to order from, most goods are shipped FOB shipping point, which means if the goods are in fact damaged or lost or stolen in transit, it is the buyer's problem and not the seller's problem. Alright, at least from a legal standpoint. The opposite of FOB shipping point is FOB destination. Right? In FOB destination, the seller retains ownership of the goods while they're in transit until the common carrier actually makes delivery of the goods that the buyer ordered. Alright? And the other distinction, it's important for inventory. So we'll work through a few of the classic examples where goods are shipped at the end of one accounting period and received at the beginning of another, and should the inventory be included or excluded? Well, it depends on whether it's FOB shipping point or FOB destination. We'll work through a few of those examples. Alright. The other thing to know is FOB shipping point means that the buyer pays the freight. Alright. It's a general rule, and generally on FOB destination, the seller pays the freight cost. So many retailers allow for purchase returns. So that means we will, in just a moment, we're going to look at the accounting for purchase returns. And we'll look at that in two forms. The first being a purchase return, which means the seller, the original seller of goods, receives the goods back and issues credit, or a purchase allowance, which means that the buyer keeps the goods but will be granted an allowance or a reduction in the original price. Right. Generally, that would be done for low quality or goods that don't meet the initial quality standards, or goods that have it's not economically feasible to return them. Alright, we definitely want to get comfortable with credit terms for purchase discount. One example is 210 net 30, which basically offers the seller a 2% discount if the amount owed is paid within 10 days. So this 2 is for a 2% discount if the amount on the invoice is paid within 10 days. If not, or i.e. for days 11 through 30, outside the discount period, the net amount, so that's what the N means, 210 net 30. 2% discount if paid within 10 days. Net are the full amount, net any returns and allowances due within 30 days. Alright. So a few other discount terms. 210 net 30 is the most common we'll see. But you can see variations of that, 310, 1.510, or what have you. Here's some others. 110 net 30. I'm sorry, 110 ELM, so 1% discount if paid within the first 10 days of the next month. Net 10, which means the seller expects to be paid within the first 10 days of the next month. Alright. Oops. Let's get rid of that. Alright. Okay, so now we're going to take a look at E5-2, and this is on page 257. All right. So I'll blow it up a little bit. Okay. So it tells us, again, starting with the instructions, prepare journal entries to record these transactions on the books of Harwood Company under a perpetual inventory system. That's instruction A, which gives us a framework for the expectation. So let's jump back up into the problem. Information related to Harwood Company is presented below. So we're going to journalize these transactions. All right. Transaction 1 through 5. We'll start with 1. Just a little bit. All right. So on April 5th, purchased merchandise from Botham Company for $23,000, terms 210 net 30, FOB shipping point. All right. So FOB shipping point tells us that on that date, that inventory is now the property of Harwood Company and no longer the property of Botham Company. What do we need to do? We'll debit the inventory asset, and the credit goes to accounts payable, right? Because the inventory hasn't yet been paid for, right? And if you were confused by the account payable, it gave you the credit terms, 210 net 30. Credit terms wouldn't be applicable in a cash transaction, so that's how we know that this is not yet paid for. Alright, and that's the first transaction. Second transaction, on April 6th, paid freight cost on merchandise purchased from Botham. Okay, so one of the rules with inventory is that all costs related to getting the inventory on site and ready for its intended use or ready for sale is an inventory cost. So since the freight had to be paid on the inventory, we'll add that to the inventory asset account. Alright, so the debit goes to inventory. And this is a cash transaction, so the $900 cash would be paid directly to the shipper. So this would be akin to, paying UPS $900 for delivery of inventory. All right. And again, the reason that we increase the inventory by the amount of the freight charge is because it's an inventory cost. It's a cost to get inventory to the site and ready for sale, and eventually, as we'll see in the exercises to come, it flows through and eventually becomes cost of goods sold. All right. 3. On April 7th, purchased equipment on account for $26,000. Alright. So I think we've journalized similar transactions to this before. Alright. And that's what that entry looks like. On, let's see, transaction 4. On April 8th, returned damaged merchandise to Botham Company and was granted $3,000 credit for returned merchandise. Alright, so the return of inventory before it's been paid for, so keep in mind, this is a return of this inventory, and it hasn't yet been paid for. So the return is the mirror image, or the exact opposite of the initial entry. So we'll debit accounts payable because we no longer have to pay for that inventory, and we will credit inventory because in this case $3,000 worth of inventory would be returned to the seller. Alright. And in transaction 5, we have on April 15th, wrong cell there. On April 15th, paid amount due to Botham Company in full. Okay, so the initial credit terms were $210 net 30. So when we see a payment in full, we want to think of whether we're inside the discount period or outside of the discount period. So 10 days from April 5th would include the 15th. Alright, so we are inside the discount period, so we know that Harwood Company is going to be entitled to take a 2% discount. Alright. The other thing to be aware of is we also return inventory. Right? So here, 23,000 was owed, but 3,000 of that was reduced when some inventory was returned. All right. So the first step in paying off the receivable in full is that the full amount, in this case, the 20,000, the initial 23,000, there. Less the $3,000 worth of goods returned. So it's not the 23,000 that would be paid, but the 23,000 less the $3,000 of return. So payables comes off the books at $20,000. The Harwood Company is entitled to a 2% discount. Alright, so they're going to pay some cash, but it'll be 2% less than the $20,000. Alright, so what you can do to calculate the actual amount of the payment sent is to take the 20,000 here, the amount still owed on the account payable, and take 1 minus 0.02, which gives you 98%, would be the amount paid less the 2% discount. This gives you 19.6. That's the amount of the check that would be cut. Now, the check that would be cut and sent to Botham Company. The issue here is now, at this point, the entry doesn't balance. Alright, so we need one more thing. And it's going to be a reduction in inventory that balances the account. in this case, $400. Right? And if that doesn't make sense, what we're doing here is, since Harwood Company took a discount, they actually end up paying less for the inventory. So the credit to the inventory account reduces that inventory account, which makes the valuation of inventory lower. In this case, $400 lower. So when discounts are taken by the buyer of inventory, the amount of the discount serves as a reduction in the inventory valuation account. Alright? Part B. Let me insert here to label. Alright, so in Part B, it says, assume Harwood Company paid the balance to Botham Company on May 4th instead of April 15th. Prepare the journal entry to record this payment. Okay, so the difference between May 4th and April 15th is, of course, the May 4th date is outside the discount period. So what does a payment look like outside the discount period? Well, you would still have the $20,000 debit to reducing the account payable liability account, and the amount of the check cut to Botham Company would be $20,000. So that is Part B. Part B illustrates payment on account outside of the discount period, whereas Part A, Journal Entry 5, illustrates payment on account for inventory inside of the discount period. Okay. So that is a quick level of exposure to our buyer, the transactions for the buying of inventory. Throughout this, we will very soon we'll look at the mirror image, or the other side of the entry from the seller's perspective. All right. Okay. Okay, so what we're looking at here is an invoice. In the next learning objective, the third learning objective in Chapter 5, we shift from the recording of purchase transactions like we did in learning objective 2. You may recall we journalized the purchase, return, and payment for merchandise, our inventory. And for the payment, we journalize both inside and outside of the discount period. Okay, so now we're shifting gears and turning to the other side of that transaction. So when a company purchases inventory, there's also a company selling inventory, and that's what we're going to journalize now, the sale of inventory. This is going to be your revenue transaction. So that should feel somewhat familiar to us at this point. And we're looking at an invoice here. The invoice typically would be the document that indicates to the accounting function that they need to journalize sale of inventory. So let's take a look at the basic journal entries. So we see journal entry 1. We have the revenue transaction, the actual reporting of revenue, and we see that credit to revenue for the selling price. So that's the actual retail price that the consumer or the customer purchases the inventory or the merchandise at. Right, and that's the credit. So the revenue we see as either cash or accounts receivable. All right, and that should make sense. Cash is for cash sales. Accounts receivable is for sales on account. Commonly, those will include discount terms. We'll address how to deal with that in just a moment. And remember, the second entry really only happens in perpetual inventory systems as opposed to periodic inventory systems. And that may not make a lot of sense right now, but we'll get deeper into it. But effectively, if you're given the cost of the goods sold, you want to record that cost. And so that the cost of goods sold is actually an expense account. Generally, it doesn't have expense behind it, but for our purposes, we may use cost of goods sold expense so that we're absolutely sure as to what that account actually is. And inventory, that's our inventory asset account. So you can see with this entry, the second entry, we're increasing an expense, cost of goods sold expense, and we're decreasing the inventory asset account. As it relates to returns and allowances, the thing to remember here mainly is that sales, returns, and allowances is a separate account from the sales. So when sales are returned, we don't debit the sales account because it would make it difficult to track statistically, returns, the magnitude of returns at any given point. Whereas if we use the contra revenue account, which is a revenue account and has a normal debit balance, we've been exposed to some contra accounts before, i.e. accumulated depreciation. So contra revenue account is just a revenue account that has a normal debit balance. And this contra revenue account is sales, returns, and allowances. Sales discounts is another contra revenue account. When discounts are taken by the buyer, just keep in mind we're journalizing transactions for the seller. So when discounts are taken by the buyer, we report in the sales discount account. Again, a revenue-related account with a normal debit balance. And as you can see on the screen here, we have to take, in this case, sales revenue, sales returns and allowances, and sales discount. The net of those is net sales. So we see revenue has a credit balance as we would expect. Returns and allowances would have a debit balance, and discount would also have a debit balance, which actually serves as a reduction in total sales, and this is the total sales, our net sales that we would see on the income statement. All right. Just like how to journalize sales transactions, sales of merchandise transactions. All right. What we're going to take a look at now is a problem that actually requires us to compare and contrast the journalization of purchase of merchandise transactions and sale of merchandise transactions. All right. So there are a few ways that this can come up. All right. It can come up like the problem we're getting ready to take a look at, E5-4, where we journalize the same transaction on the books of two different companies, i.e. a buyer and a seller. All right. The other way in which it can come up is we're giving one company to journalize transactions for, but we have some buying and selling transactions to journalize. So we want to be prepared for both of those ways, and we'll spend some time working through both of those approaches. All right. So now we're going to get into E5-4. And we'll start with the instructions. Instruction A. Prepare separate entries for each transaction on the books of Toombs & Company. Alright. And part B. Prepare separate entries for each transaction for Epps Company for merchandise purchased by Toombs on June 10th at a cost of $4,800. Okay, so that's what we're going to do. We'll start with part A, which should be somewhat similar to exercise 5-2, which we previously looked at. So we're going to get some more practice with that, and then we're going to take a look at transactions on the seller's book. All right. So leading into the fact pattern, on June 10th, Toombs & Company purchased $8,000 of merchandise from Epps Company. FOB shipping point, terms 210, net 30. Toombs pays the freight cost of $400 on June 11th. Damaged goods totaling $300 are returned to Epps for credit on June 12th. The fair value of these goods is $70. On June 19th, Toombs pays Epps Company in full, less the purchase discount. Both companies use perpetual inventory systems. Alright, so those are all the transactions. We'll have to go through them one by one, journalizing them. So we'll start with the June 10th transaction. Toombs & Company purchased $8,000 of merchandise from Epps Company. Alright. Purchase of inventory. We did a similar transaction E5-2, so this should look familiar. It's on account payable because the credit terms were given, 210 net 30. That wouldn't be necessary for a cash transaction. Alright. So we have the debit to inventory and a credit to accounts payable in the amount of $8,000. And that pretty much takes care of the June 10th transaction. On the 11th, Toombs pays freight costs. So we know that freight costs for the purchaser increase the inventory costs. Right? All costs necessary to get inventory on site and ready to sell are inventory costs. Right? So we want to avoid freight expense or shipping expense in this circumstance. In this circumstance, it is an increase to the inventory account. Alright? Freight transactions are going to be cash in our book. Alright, so that's $400. Alright, on the 12th, damaged goods totaling $300 are returned to Epps. Okay, so when we look at what's happened here, there hasn't been any cash payment yet. Alright. So what's going to happen? The goods are going to be returned and the company's not going to be obligated to pay for them. So what that is a reduction in account. On the 12th of June, damaged goods